morning. We're the management team that was in charge of the Tamarack resort for the past year. Today we will present a summary of our performance during this year, followed by the analysis of the results and short and long-term recommendations for the next years. First, we will present the background of the hotel and the market, our positioning strategy, as well as our pricing strategy. For the past year, our management team has been operating Tamarack Resort as it offers benefits to the owner. For example, brand recognition, chain affiliation, etc. The owner paid us monthly standing charge as well as the basic fee based on the revenue and the incentive fee based on gross profit. Tamarack Resort was opened 8 years ago and since then has not undergone any refurbishments. Our hotel welcomes all the market segments: business, leisure, tour, contract, large group and small groups. Our competitors at the start of the year were all at the same level. No one had advantage in their facilities, footprint or services. The market's performance has steadily decreased over the past 2 years and competition from other cities has increased, which caused the occupancy to erode. Plus, there are certain obstacles to get outside financing for us and our competition. However, the future looks promising as positive property developments are being made as well as area developments. In light of the positive economic developments, owners promise to improve our hotel's competitive position by making replacement reserve funds available. The owner of the hotel set 2 objectives for us at the beginning of the year, which were to achieve and maintain above fair market room share and ADR equal or higher than our competition, and to generate annual gross operating profit in excess of 25% and a return on investment in excess of 10%. Later on, we will see if we've met those goals at the end of the year. Before its management team started operating Tamarack Resort, the market indexes followed this trend. Occupancy and RevPAR peaked in August and declined dramatically over the next couple of months. From historical data, we knew therefore that high season months should be July to September, and a big decline on revenue was expected from the months that would follow. Since the beginning, we assumed our competition would target business travelers or groups. The historical data for average segment mix during weekdays showed that premium and bar were highest percentage of clients, and for weekends, bar and tours. Therefore, we decided to target leisure travelers who, as historical data showed, would request premium and standard rooms. We knew that leisure guests would require the hotel to be refurbished, especially for services like foreign exchange, concierge, transport van, and others. The reasons why we chose to target leisure travelers is because the city where we are located provided many attractions: 7 museums, restaurants, festivals, and others. For the marketing expenses, we decided we would always invest from 3 to 4% of our monthly revenue on direct and GDS channels. From historical data, we could see that demand was always higher for these channels, for all the segments. Our pricing strategy followed a customer value-based pricing. We did not want to be positioned at the cheapest hotel and wanted to provide possible facilities that leisure travelers would require. In the price value map, we wanted to be positioned as high price and high quality.
These were all our decisions before the simulation started. Now we will look at how we performed during our management year. The market indexes varied a lot compared to the previous year. The highest occupancy was in March and the second highest in June. Also the month where RevPAR was the highest. Occupancy decreased in July, which was not expected, and increased again in August, only to drop dramatically the following month. After June, occupancy was never above 100, meaning we did not outperform the competition in the second half of the year. We started turning a profit in March, when we were able to recover from all the investments made in the first 2 months. Both total revenue and net profit peaked during July and August, which was expected as the indexes from the previous year showed the same trend. Since we focus on premium and bar rates, leisure travelers require premium and standard rooms. These are the prices that mostly show our performance. For the premium rate, both during weekends and weekdays, we charged higher prices in August and September and decreased overall prices after these months. For the bar rate, higher prices were charged in August and September for weekdays and in September and October for weekends. For both premium and bar rates, after seeing that our prices were much higher than the average in January and February, we dramatically decreased them, and later increased them again as they became too low when compared to the average.
By comparing the 4 quarters, we can see that over the year we managed to increase revenue, the high season being in the 3rd quarter. Furthermore, we managed to reduce the expenses in proportion to revenue and increase the GOP over the year. In the 1st quarter, we had a net profit of minus 39.185, and in the peak, the 3rd quarter, a net profit of 19%. Marketing expenses went up gradually over the year, even though our revenue went down in the 4th quarter. We received 4 requests for proposals during the year. We did not propose any rate for the request given in April, and all of the 3 proposals were not accepted, as the competition's proposals were always cheaper.
Now we'll present the analysis of our performance. Our occupancy during weekend and weekdays remained very similar until May. Changes in occupancy patterns started in the middle of May, and during the high season, weekend occupancy was much higher than weekday. In September, patterns shifted completely. Weekday occupancy became higher than weekends. This shift in occupancy pattern is not due to variation in rates charged during the whole year, as it is possible to see in the following graphs for rates charged in the bar and premium categories. Prices for weekends remained lower than weekdays for the whole year. Our analysis showed that this shift in occupancy that started in September is most likely due to our marketing expenditure. This graph shows how our total marketing expenditure increased currently over the year and how the spending did not exceed 4% until June. From September on, a significant increase in spending occurred, with a peak of 7.24% of monthly revenue in November. In the last quarter, average expenditure on weekdays reached 42%, while on weekends it was only 19%. This is a much bigger difference than in the first 3 quarters, which might explain the difference in occupancy seen before. As we always invested more in weekdays than on weekends, on the long term, it could be what contributed to an increase in occupancy during weekdays.
As shown in the graph, the distribution channel that generates the most revenue for Tamarack Resort is the direct channel, consisting of approximately 63% of the revenue mix, followed by GDS with approximately 24%. The distribution channels OTA and wholesale have the smallest contribution on the revenue, 8% and 5% respectively. According to channel demand and transaction costs, transient guests, being our target market, prefer direct reservations. Consequently, we focused our investments in marketing on that distribution channel. As historical data showed, tours who use wholesales as their channel usually come in June, so it made sense to invest a bit more than we did in the previous months, 9.2%. Even though we were focusing our marketing campaigns and price strategies on the premium and bar segments, the second highest segment that brought most profit and revenue was large groups. This was probably due to the fact that we had relatively low prices for large groups, which resulted in 10.42% market share. On the other hand, in our target market segment, premium, we only had 11.34% market share due to relatively high prices. However, the high prices were following our pricing strategy, as we were aiming to position ourselves as high quality and high price hotel. Conclusively, our marketing expenditure were not in line with the market demand. As said in our positioning statement, since the beginning we decided to always invest a maximum of 4% of monthly revenues in marketing. Because in the 3rd quarter our revenue was very high, marketing expenditure for the following quarter was very high as well. However, from historical data, we should have known that occupancy and therefore revenue would dramatically decrease starting in October. Consequently, we should have adapted our marketing strategy to spend less and therefore have less fixed costs in the last quarter. We attributed a very bad 4th quarter to this lack of attention to the historical data and too much spending on marketing.
Finally, at the end of the year, we were able to check if we met the owner's expectations. The only goal we did not achieve was to generate an ROI in excess of 10%, as the return at the end of the year was 7.81% because we invested a lot in our property. Our market share was slightly above the competition's, and the ADR was $10 higher than the competition's. Additionally, our GOP exceeded the target set by 14%. Following our analysis, we would like to make some recommendations for the owners of Tamarack Resort for the years to follow. In the short run, Tamarack Resort should reduce the apartment cost of direct sales and keep prices lower than we did this year, until the next Ironman season, when prices could increase again. Furthermore, no investments in new facilities or services should be made in the short run, but it is very important to maintain the refurbished facilities. In the next year, the hotel should advertise in the bar segment through a direct distribution channel, as it is the one that brings the most revenue. In the future, more segments and more rates should be considered, and focus should not be put only in 2 rates. The marketing and advertisement spending has to be adjusted to the overall market demand within the year. Since the hotel plans to be high quality and high price, it is important to invest in the property to distinguish the offer from the competition. After generating return from the refurbishments made this year, the hotel can consider additional refurbishments if there is demand for it in the market. In order to have all facilities and rooms available in the high season and avoid the performance curve seen this year, where the contribution margin went down and the expenses up in the last quarter, it is important to invest in the beginning of the year and to reduce the expenditure in the last quarter.